Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. Eastern, every Monday morning. Get you ready for the week. Stocks to watch, economic news that could guide the market. The market continued its pullback last week, and investors are worried that this is something worse, something more than just a pullback, a full-on stock market crash. I was in New Orleans last week and ran into Matt, a longtime citizen of the Bowtie Nation. And it's always great running into all of you out there in real life, and talking to Matt really brought to life what we're all feeling as investors. But the good news is this is not a stock market crash. I'm going to go out on a limb here because there are a lot of big name investors like Mario Gabelli and Michael Burry saying that a crash is imminent. I'm going to explain why the bull market is alive and well and how to invest in that next. Stick around, we'll do our Monday market update after that, stocks to watch, and the economic news you need to see. Back to our main topic though, because investors are worried that this is a stock market crash happening. Michael Burry in fact is betting $1.6 billion that the stock market crashes by the end of this year. Stocks are now down 8% from their July high and have cut their year-to-date gain back to 10% for the S&P 500. Higher interest rates are the culprits here, drawing investors into safer money market funds out of stocks, really destroying the valuation for those growth stocks. And to get a sense of where those interest rates might go, we can go here to the CME FedWatch Tool that shows us market probabilities based on those interest rate futures of what the Fed is expected to do over its next meetings. Here we can see the meeting dates. Next one here, November 1st. We've still got one more after that in this year, and then next year's meetings, the January 31st and March. And we can see here in the blue, this is the market's highest likely probability based on those based on those interest rate futures, what the market is expecting the Feds to do. 525 to 550 is the current 550 basis points on the federal funds rate. We can see that the market is expecting the Fed to stand pat for the rest of the year and into next year. But the market is putting about 1 in 3 chances, about 30% chance that the Fed does increase the interest rates in that January meeting. Now, that's important because another interest rate increase after all we've seen over the last couple of years could destroy the economy and stocks. And even members of the Fed like St. Louis President Bullard and Cleveland President Messer are warning that rates may need to be raised one more time. But against this consensus view and the stock market crash that it would cause, I found data that shows that the Fed is not likely to increase rates again, and their next move would be to cut, and maybe even earlier than expected. That would be a positive for stocks in next year and would keep this bull market alive. First off, before showing you that data, understand that Fed members like Chair Powell are going to probably continue to talk tough and warn of potentially higher rates. They're watching the same data I am, pointing to an economic slowdown, but if they were to publicly acknowledge all that and that the Fed hikes are over, the market would rally, interest rates would come down in anticipation of those future rate cuts, and the economy would jump back into growth. And so it's all kind of a perverse irony that would require the Fed to then hike rates again to slow down the economy and inflation. Okay, the Fed is raising interest rates to slow down the economy, slow down inflation, fastest inflation we've had in more than 2 decades. And to say that those interest rate increases are over, the market would anticipate higher economic growth and would push inflation up higher. So the Fed has to continue to talk tough, keep those interest rates higher to slow down the inflation that we're still seeing. I expect most Fed members know that the central bank is done raising rates, but they just can't come out and say it. And my reasoning behind no more rate hikes is clear and objective. The fastest rate increases in 40 years have crushed the commercial real estate market. So first, understand that most commercial property loans are interest only. So the borrower of that commercial property, whether it's office space, storage, data centers, whatever it may be, hotels, they only pay the interest on those loans and then they refinance it every 5 or 10 years. Now, the problem here is more than $1.5 trillion of these loans is coming due over the next 2 years through 2025. Fitch Credit estimates that a third of that won't be refinanced because those higher rates made the properties really unprofitable. A lot of landowners or a lot of commercial property owners are just letting those properties go back to the bank because if they're having to refinance those at 8 and 9 and 10%, they're no longer profitable against what they were financing them for over the last decade. That kind of chaos in real estate then in turn is going to flow through to the banks holding those loans. Banks are already tightening their lending standards after this spring's crisis, and it's going to tighten even further to protect that cash flow in a real estate crash. All of this is going to come together, hit the economy on those lower asset values for property, to tightening supply of loans for consumers and businesses. And we're already expecting the Purchaser Managers Index, the PMI reports this week to show that both the services and manufacturing sectors are in recessionary contraction. Okay, manufacturing sector in the United States has been in contraction for a while now. The services is just about to enter it this week. according to data we're going to get, and it's likely only going to get worse. Yes, I know the jobs market is still very strong. Retail sales last month still showed that the consumers were spending. It is that resilience that has helped drive the interest rates like the 10-year Treasury up nearly a full percent in the past month, the highest since 2007. So in a sense, what we've seen that the market is doing the Fed's job for it, pushing up that cost of borrowing, those higher interest rates. Besides that pain that's coming in commercial real estate and banks, higher interest rates are just eventually going to choke off the economy and employment, consumer spending as well. The Fed knows this. It's watching the carnage in real estate and in banks. The fact that Fed members are still talking tough on rates is just a game that they have to play. Now, I know that might be a little confusing considering we're talking about real estate carnage and a banking crisis. Stocks are likely to drag lower before investors realize that the Fed is done in raising interest rates, but the downside is probably capped somewhere around 3,900 to 4,150 on the S&P 500. That would be about 2% to 7% lower from here. Now, that worst case scenario would be especially painful for investors in growth stocks. You know, those growth stocks always fall more than the market, so that could translate to 10 or 15% losses in some of those growth stocks. But we're not talking about that kind of bend over and put your head between your knees level of crash. So if we look here at FactSet earnings, we can see the forward PE ratio over the last 10 years. This dashed blue line here is the average over the last 10 years. We can see right now is just above that, so a little bit more expensive on a PE ratio according to historical standards of 4,000 on the S&P 500. So again, that's between that 3,900, 4,150, bottom that I'm expecting in the S&P 500. That would be about 17 times my 2024 forecast for index level earnings. Right now, I'm expecting companies in the S&P 500 to report about $230, $235 per share as cumulative earnings for that index. So 4,000. The 4,000 price divided by earnings, divided by that 235, that would give us about 17 times on a price to earnings ratio. Here we can see going back 10 years, that 17 times PE would put us back into fair value territory. That also means, though, that the rebound, once investors realize that the Fed is done raising interest rates, is likely to be fast and take stocks back into the recent highs. If we do see that the economy and real estate play out as I've laid it out here, the Fed is going to jump in sooner than expected with those rate cuts. Again, looking at the CME FedWatch Rate Tool, we see that that's not expected until June of next year. We can see here the market odds are not expecting a rate cut until June 12th meeting next year. I'm saying if everything comes out here, the economy starts looking weaker, real estate comes down hard, we could see this as early as May or even March of next year. So understand what I'm saying here. With that Fed funds rate now at 5.25%, 5.5%, that gives the Fed a lot of room to cut interest rates and support the economy if all this does come true. A rebound rally from 4,100 back up to just this year's high of 4,600, that'd be a 12% return and even higher for those growth stocks. So how am I investing in all this? I continue to like that barbell investing strategy that we've talked about on the channel. That's where you hold maybe growth stocks or something really risky and that's going to take your portfolio higher in a bull market. So those growth stocks on one side, and then compared to balancing that out on the other side of the barbell is your very safe cash and ultra safe investments. Okay, so I have some of my cash in a SoFi savings account earning 4.5% interest on that. The rest in a CD, a no penalty CD from CIT Bank that earns 4.95% interest. I'll leave links to both of those in the description below the video. The side of the barbell that protects me, this side of the barbell protects me as the market pulls back and gives me the opportunity to take advantage of those lower prices on those growth stocks as they do come down. As the stock market finds the bottom of this pullback, I gradually use some of that cash on that side of the barbell to put more into my growth stocks. Right now, I've already increased my position on longer-term favorites like SoFi Technology, ChargePoint Holdings, and Fortinet, along with some of the short-term investments we've talked about in AAP and Tiva. Nation, it is times like these when the market pulls back and investors worry about a stock market crash that you need to look at this as an opportunity. You're getting stocks at an 8% discount to where they were just a few months ago, and the S&P 500 is still down 12% from its all-time high set last year. Long-term investors can be confident in those valuations, and even short-term investors can look at the data and just be comfortable that the market is not about to crash. I want to highlight some of the stocks I'm watching this week. First up, Matador Resources, ticker MTDR. This one reports earnings on Tuesday with shares up 18% since the announced acquisition of Pioneer Natural Resources by Exxon. I highlighted Matador recently in Friday's video as one of the top producing Permian Basin oil explorers that could be the next to be acquired. After PXD, Matador is the 8th largest Permian producer with 148,000 acres in the region and around 150,000 barrels of oil per day production. That recent run-up in the price has taken the shares to about 2.8 times trailing revenue, but there's still some upside space if the company can get an offer from a larger buyer. Next up here, Teladoc Health, ticker TDOC, also going to be reporting its earnings on Tuesday, with analysts expecting just 9% sales growth and the loss per share to narrow to 37 cents a share. Now, Teladoc has been one of my most frustrating stocks since I started buying in 2022. Revenue growth has slowed considerably to just that 9 to 10% range, even as the company continues to add scale and just dominate that market for virtual healthcare. I still like the virtual healthcare business or the industry as a long-term growth trend, but it just seems like the catalyst is no longer there to force change in this industry. Now, my cost basis on these shares is now at $36, but I'm getting to the point where Teladoc management needs to convince me that it can still be a part of my growth portfolio, or I'm probably going to just take losses and put the money somewhere where it's going to grow faster. Also here, O'Reilly Automotive, ticker ORLY, is scheduled to report Wednesday, and it's going to be an important comparison for Advanced Auto Parts, ticker AAP, reporting November 13th. Now, AAP has significantly underperformed its competitors over the last several years, but now has new management and what could be a second chance and what could be very strong returns for investors. I highlighted that, the reasoning I'm buying AAP in a recent video I'll link to in the description below. Recent retail sales showed a strong uptick in sales for auto parts stores, and so I'm going to be watching O'Reilly earnings to confirm that demand. Medical Properties Trust, ticker MPW, also going to be reporting its earnings on Thursday, with investors watching closely after the stock's 62% plunge this year. Now, some of this is an interest rate story, with all real estate really getting slammed on higher rates this year, and some is generalized weakness in the hospital operations market weighing on those hospital property owners, but management here deserves its share of the blame as well. MPW overexposed itself to its largest tenants and has progressively tied its finances closer to those top two, Steward and Prospect. Now, investors are going to be watching for clues that the company can survive further weakness in the market and what point shares can begin to rebound. Looking at the bigger picture here on the sector tracker, sectorspiders.com, we can see that 2 of the 11 sectors did close higher last week, energy following the price of oil higher, and consumer staples really asserting their safety stock status. Now, that safety in staples should continue, with valuations attractive in the space. So if you are looking for somewhere to hide your stocks in this market, look for consumer staple stocks. Stocks in the healthcare sector also provided some protection, with drugs and device makers doing relatively well. We're into our biggest week of earnings season this week, and earnings have been good for stocks, though you wouldn't guess it by looking at stock prices. That's because no matter what management says, how earnings come out, or how good the outlook has been in the stocks that have reported, stock prices are moving higher or lower together with the market. A war in the Middle East, jumping Treasury yields, and inflation fears have really overshadowed what companies are saying about their stocks. In the week since earnings started coming out, 80%, that's 400 of the 500 stocks in the S&P 500 have trended in the same direction. And that is a very high number. Average is closer to about 37%. So normally stocks that have good earnings reports go up. Stocks that have bad earnings reports go down, no matter what the market is doing. Right now, we're seeing all the stocks in the market go the same way, the same direction as the market, because investors are just so preoccupied with that bigger picture story right now. The good news in this is that sets up a buying opportunity for you as an investor. Companies reporting strong earnings, beating expectations, and providing that outlook that should see the stock price go higher are not being rewarded. Investors that can look past these near-term fears can pick up these stocks at a discount, see those higher prices once the fundamentals reassert themselves and those broader macro fears subside. Get your free report, the 5 stocks I'm buying for the next 30 years, my forever stocks, with the link below. Or click on the video to the right for the 5 best short-term investments to make right now. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.